The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin, Jeong. The REIT landscape is undergoing significant transformation, driven by shifts in economic conditions, technological innovation, and evolving investor preferences. As these changes reshape the opportunities and risks within the sector, understanding how investors can navigate this dynamic environment has never been more critical. Effective risk management strategies are essential to protect portfolios amid market volatility, while cross-border investment adds layers of complexity and requiring nuanced expertise. So with these challenges and opportunities in mind, how do you see the REIT landscape evolving in the near future? What strategies should investors prioritize to thrive amid uncertainty? Well, to find out more, joining me now is Joseph Ong, who is a co-founder and executive director at EuroAsia Asset Management. Joseph, welcome to the show.
Hi, Hongbin. Thanks for having me.
Thank you so much for joining me. Joseph, how have the REIT landscape changed over the past few years, and how are macroeconomic factors such as, interest rate shifts and inflation influencing REIT performance?
It's been an incredibly dynamic few years for REITs. We have seen a shift from the low interest rate environment that supercharged many REITs pre-2022 to a period during 2022 to 2023 where rising interest rates have pressured valuations, especially for those with significant debt. Inflation, on the other hand, is really a double-edged sword. While it increases operating costs, it also drives rental growth in many sectors, acting as a natural hedge. I would say, all in all, the REIT landscape over the past few years have been characterized by the impact of rising interest rates, leading to significant declines in 2022 and 2024, with just a slight recovery during 2023.
So what are the promising or most promising sectors within REITs today?
Yes, given the current economic climate and expectations of easing interest rates, the more promising sectors that we have identified within REITs will still be the data center REITs. These are driven by accelerating AI, cloud computing, and digitalization, leading to robust demand and continued strong rental growth for these sectors. And other sectors that we actually point out to will be healthcare REITs. These are very defensive and resilient. It benefits from inelastic demand due to aging population and offering stable long-term income streams. One last interesting sector would be retail parks, which our fund, SecDR Investment, is focusing on. So now when we say retail parks, we are actually not talking about the traditional multi-story shopping malls that face headwinds. We are referring to these convenience-led open-air retail parks anchored by essential services like supermarkets, pharmacies, and discount retailers. So these properties cater to daily necessities. They naturally benefit from consistent footfall and predictable rental income during economic downturn. So we will say that this sector will be especially promising to look at in view of the uncertainty in the macroeconomic environment brought by the erratic trade policies. Yep.
So what are some of the trends in the REIT sector you are witnessing amongst investors? How are retail investors versus, institutional investors adjusting their approach to REITs? Are there any differences?
Okay, so two parts to this question. Firstly, the trends in the REITs sector. We are still looking at the yield attractions. With interest rates easing off, REITs continue to appeal due to their relatively attractive dividend yields. Currently, we see around 6 to 7% for many, which is higher than alternative options like T-bills and saving bonds. This income-generating characteristics remains a key draw, and we are also looking at the trend of going on the valuation play. Many REITs are still trading at a discount to their NAV, suggesting a potential upside for investors who believe in the long-term value of the underlying assets. So it's really to buy and hold and let the valuation play out in the long run. And on the second part of the question, you asked retail investors versus institutional investors. This is an interesting one. We are seeing retail investors and institutional investors naturally acting very differently. Retail investors are typically net buyers during weakness. They are more income focused, they are a lot less sensitive to short-term volatility. On the other hand, for institutional investors, we are seeing them as net sellers during weakness with selective re-entry. They focus very much on capital preservation, portfolio balancing more than just chasing the income and yield. And they are more selective on sectors. Yeah.
Well, speaking of trends here, Joseph, how are investors approaching diversification within a REIT portfolio to balance returns and risk then?
Yeah, I would say diversification is absolutely critical. Investors are looking to beyond just having multiple REITs in their portfolio. One of the areas they're looking at for diversifying is on the geographic geographic diversification, not just Singapore or even Asia, but spreading across different stable economies like Europe or specific regions within. So this actually helps to mitigate country-specific economic downturns. Another way to diversify would really to be looking at sector diversification by blending exposure to different property types. While we see industrial and data centers being very popular, we are also seeing more recognition of diversifying into more defensive sectors like necessity-based retail or healthcare.
All right. So then, speaking of risks here, what are the key risks facing REITs in today's market?
The key risk we observe today is still the same risk we have observed for the past 20 years, I would say. The same one, like interest rate sensitivity. Higher rates increase borrowing costs and impact valuations, especially for higher geared REITs. Another risk that we're looking at is inflationary pressures. While, as mentioned, rents can rise, we are also seeing increased operating costs eating into net operating income. So if these are not managed effectively, it actually reduces returns to the investors. On the economic side, on the macro side, we are identifying economic slowdown, recession as one of the key risks, which will impact tenant demand, occupancy rates, and rental growth.
Right.
Yep.
On that note, what tools or metrics should investors rely on when evaluating risk exposure across a REIT portfolio?
Okay, so for this, beyond the standard quantitative metrics like NAV and distribution per unit, our company also looks at very much on the qualitative side of things. One of these metrics are the tenant quality and diversification of the tenant mix. Basically, this is to assess the creditworthiness of tenants and to ensure that there's no over-reliance on any single tenant. We also do stress testing, running various stress scenarios such as interest rate hikes, economic slowdowns to see how the whole portfolio will perform under adverse conditions. So taking on this forward-looking analysis is very crucial to ensure no blind spots are missed. Yeah.
Okay. On that note as well, what are the main challenges in managing REIT investments across different jurisdictions?
Well, managing cross-border REIT investment definitely comes with its unique set of challenges, and there is typically a high barrier to entry that requires deep expertise. Some of the hurdles we have to overcome include like regulatory and legal complexity, with every country having their own property laws, tax regimes, and operating regulations. So understanding and complying with these are very important. We're also looking at tax implications as one of the challenges we need to overcome, where we have to manage the double taxation treaties, the local property taxes to optimize returns for investors. Lastly, on the local market cultures, real estate being a very tangible asset is very inherently local. You do need strong on-the-ground teams to understand local demand drivers, tenant preferences, and market dynamics.
And how do currency fluctuations impact cross-border REIT performance, and how do you hedge against that risk?
Okay, so the impact from currency fluctuations when it comes to REITs come from various angles, namely the translation risk, where we see changes in NAV when foreign assets are converted to the home currency. We also see transactional risk, where there's a direct impact on rental income and expenses when foreign currency earnings are converted for distribution. So how REITs actually hedge against this typically is a natural hedging. They borrow in the same foreign currency as the income-generating assets to offset exposure. They can also use financial instruments such as forward contracts, currency options, and currency swaps to lock in exchange rates for future income. But ultimately, while these hedging actions stabilize DPU and protect NAV from currency volatility, we see the downside as where there's a compromise in maximizing DPU. This is also the reason why our firm believes in managing our fund to invest in a single currency exposure, removing the downsides of hedging while still allowing investors to take on the euro as a diversification for their own portfolio.
Okay. Well, overall, what advice would you give to new entrants in the REIT market about, navigating compliance risks?
Well, my advice would be really to do your due diligence well. You must understand the regulatory framework of both the fund's domicile and the target property markets before you commit. You need to really build a strong team, or at least partners with professionals who have deep knowledge of both real estate and regulatory compliance. And staying updated with the regulatory landscape is very important, and there's a need for constant monitoring and adaptation. Yeah.
All right. Well, Joseph, I believe you also started your own REIT fund here. Tell us more about your fund. How does your fund differentiate itself from existing REIT funds in terms of strategy or focus?
Yes, that's right, Hongbin. We launched ZDR Investment SGBCC, which is a Singapore variable company structured fund. Our key focus is on investing in resilient retail parks across Europe. How we differentiate ourselves is through a very deliberate strategy. We have a very niche focus with deep expertise. While you see some funds, they are diversified across different sectors. We are specializing in a single proven asset class, that is European retail markets, where we have deep sector-specific knowledge and on-the-ground presence. This allows us to do very focused due diligence and value creation. At the same time, we are able to deliver recession-resistant income. We prioritize properties anchored by essential retailers, ensuring stable and predictable rental income that can hold up even during economic downturns. So this is a significant differentiator from traditional discretionary retail.
Okay, you mentioned that it could, hold up despite market downturns here, but how does your fund adapt to market volatility or economic uncertainty?
So our fund strategy, as mentioned, is inherently designed to adapt to market volatility and economic uncertainty. Precisely the reason why we chose retail parks as our main assets. Our tenants are selling essential goods and services. They are largely immune to economic cycles. During economic downturns, people still need groceries, medicines, basic home supplies. So this actually creates a very stable income stream, making our properties less vulnerable to rent declines or vacancies. And our leases are also signed for a good period of over 7 to 10 years with inflation-linked clauses to ensure inflation is covered for. So with a long weighted average lease expiry, we are actually able to weather short to medium term volatility at ease.
Overall, Joseph, what trends in the REIT space are you most excited about, and how will your fund capitalize on them?
Yeah, we are actually very excited about two key trends. Number one, the return to search for safe and stable corporate yields with easing interest rates. Investors having benefited from risk-free assets with interest rates such as SGDT bills hitting as high as 4.4%. They are now back to searching for safe corporate yields that will bring them back to those levels. So I think the REIT space is definitely going to benefit from such a trend. Second key trend that we're looking at is the flight to safe quality and resilience. So with the uncertainty in macro policies and economic environment, I think investors are increasingly looking for safe assets with a decent enough yield to park their cash in. Investors are also increasingly discerning. They are moving away from speculative plays towards tangible assets with proven income stability. So our funds focus on necessity-based European retail parks directly capitalize on this, offering a stable income profile that resonates deeply with investors.
Amazing. Some great insights from you there. Thank you so much, Joseph, for joining me today.
Thanks for having me, Hongbin.
Thank you. That was Joseph Ong, who's a co-founder and executive director at EuroAsia Asset Management. This has been The Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.